If there were a dashboard that forecast your rent, job prospects, and stock returns, would you check it? That dashboard exists. It's called Macroeconomics. In the next few minutes, I'll show you how to read it so you can make smarter moves this week. We all feel the economy before we understand it. A grocery bill that creeps up, a job posting that disappears, a mortgage quote that jumps overnight. Macroeconomics is the map that explains those feelings. It zooms out from individual choices to the whole system. Millions of buyers and sellers, governments, and the central bank steering the flow of money. Think of 4 big gauges on a clean dashboard: growth, inflation, jobs, interest rates. When these needles move, your daily life moves with them. Growth, measured by GDP, tells us how much we're producing and earning together. Inflation, often tracked by CPI, tells us how fast prices are rising. Jobs, captured by the unemployment rate, tell us how many people want work but can't find it. And interest rates, largely guided by the central bank, tell us the price of borrowing and the reward for saving. Let's bring this to life with one story you'll remember. Meet Noah. He runs a neighborhood gym. When the economy grows, more members sign up, classes fill, and Noah hires trainers. Trainers spend at restaurants, restaurants pay suppliers, suppliers hire drivers, money circles through the city. That's expansion. The growth gauge climbs, the jobs gauge looks strong, and Noah feels it, in bookings, in buzz, in the hum of treadmills. But growth can run too hot. Suppose energy bills spike, equipment costs jump, and suppliers raise prices. That's inflation. Noah feels the squeeze. Raise membership fees and risk cancellations, or absorb the hit and cut profit. Across the country, everyone's doing a similar dance: pay more, buy less, or delay. Now the central bank steps in. Its job is to keep prices stable and employment high over time. If inflation runs too fast, it raises interest rates to cool demand. Overnight, loans and mortgages get more expensive. A family defers a home purchase. A cafe delays a renovation. Noah's potential new location? Put on hold. Sign-ups slow. If enough households and businesses pull back, unemployment starts to rise. What was a sprint becomes a jog, sometimes a stumble. That's the cooling phase, occasionally a recession. How does a rate hike at a press conference travel into your life? 3 main channels. First, borrowing costs. Higher rates make mortgages, car loans, credit cards, and business credit pricier. Fewer big purchases go through, and projects with thin margins don't pencil out. That reduces spending. Second, expectations. If businesses expect slower growth, they hire more cautiously. If families expect prices to calm, they delay purchases. Those expectations become actions, and actions shape the economy. Third, currency. Higher rates can strengthen the currency. Imports get cheaper, which helps cool inflation. Exports get harder to sell, which slows some industries. The mix shifts. Flip the script in a slump. When demand is weak and unemployment rises, the central bank can lower rates to make borrowing cheaper and encourage spending. The government can use fiscal policy, tax cuts, relief checks, and big projects to support demand when private spending won't. Policy is a thermostat. Too hot, prices sprint, turn the dial down. Too cold, jobs vanish, turn it up. The perfect temperature is rare. The goal is stability over time, not perfection every month. So how do you read the gauges without getting lost? If GDP growth is rising, businesses usually earn more and job openings expand. Good news, just watch for overheating. If inflation is high, your cash loses buying power. The central bank is likely to keep rates tight. If unemployment is low, workers have leverage and wages may rise faster. If interest rates are rising, borrowing cools, savings yields improve, and risk assets get repriced. Now here's how to use this dashboard like a pro. Moves you can apply this week. If inflation is high and rates are rising, prioritize paying down variable rate debt first. Those balances get more expensive in real time. Consider shifting idle cash to higher yield accounts or short-term government bills so your savings doesn't sit still while prices run. Where you can, lock in essential costs. Annual plans, fixed-rate utilities, longer leases if the terms are truly favorable. If growth is slowing and layoffs are ticking up, build or top up a 3 to 6 month emergency fund. Cash is a shock absorber. Invest in your resilience. Upskill, update your portfolio of projects, reconnect with your network. Keep investing with dollar-cost averaging if that's your plan. Volatility is a feature of cycles, not a signal to abandon a long-term strategy. If growth is strong and unemployment is low, consider negotiating compensation. Labor has leverage. If you run a business, test price and capacity. Customers are less price-sensitive when incomes are rising. Review your debt structure. If rates are low and stable, sensible refinancing can lower risk and free up cash flow. If rates fall after a slowdown, revisit mortgages and auto loans to see if a refinance makes sense. For entrepreneurs, cheaper financing can make expansion attractive. Just keep a margin of safety. Booms don't last forever, and discipline compounds. And always match money to time. Near-term goals should never depend on macro luck. Long-term goals can ride multiple cycles. Diversify so a single macro win doesn't capsize your plan. Let's return to Noah. During the boom, he added early morning classes and a corporate wellness program. When inflation spiked, he audited energy usage, locked a better utility contract, and slimmed low-value perks. As rates rose, he paused expansion and focused on retention. Better programming, clearer results, smarter scheduling. When the slowdown eased and borrowing costs drifted down, he reopened the second location plan, but with conservative projections and a cash buffer. Noah didn't predict the future. He read the dashboard, adjusted the dials he could control, and protected his downside while keeping upside open. That's the point. Macroeconomics isn't a crystal ball. It's a compass. Watch growth, inflation, jobs, and interest rates, and you'll make calmer decisions with your debt, savings, career, and business. Learn the dashboard once. Use it for life. If this helped you see the big picture behind your daily money choices, tap like so more people find it. Subscribe for weekly explainers, money theory you can use the same day. Next episode, how a rate cut ripples through housing, stocks, and your paycheck, step by step.